Let me tell you something. Most investors get wrong about tops. A top isn't one candle, it's a sequence. Once you see the sequence, you stop needing one perfect signal. Here's the shape most real tops follow. Buying pressure runs dry first, then the market retests the high, the step where most people get fooled because it looks like strength. Then, if the market clears one final trap, structure changes. Price breaks the prior support from the inside, and that's when caution becomes actionable. Running under all of it is volume, the thread telling you whether what you're seeing is real or just noise. This works on every time frame. The higher, the more it matters. Zoom out first, then zoom in for the exact level. Let's walk it through with an example. Imagine a stock that's rallied hard for 3 months and is now grinding higher on strong headlines. At some point, volume stays heavy. Candles still wide, still green, but price stops making meaningfully new highs. It creeps up, then stalls, even though buyers are clearly still showing up in size. Picture blowing up a balloon. Every breath takes more effort, but it barely grows anymore. Someone is quietly absorbing all that enthusiastic buying without letting price react. Large institutions can't sell into a quiet market, sell too fast and they crush their own exit. But in a euphoric market, where everyone wants in, there's finally enough demand to absorb real size quietly. Strong buying pressure, producing very little further upside, isn't strength. It's someone using the enthusiasm to get out. Back to our example. After weeks of stalling, buyers exhaust themselves and price starts drifting down. Not because sellers flood in, but because there's no one left to buy. Is this the top or just a pause? The market answers by testing that same high again. If the retest comes on lower volume, smaller candles, weaker bodies, that's your evidence. The first wave was loud and aggressive. This one is thin and half-hearted. Then the market often goes sideways. Volume contracts, range narrows. Boring to watch, but it matters. Because whoever's distributing can't dump everything at once without crashing their own exit. So they do it in pieces. This is exactly where people get caught. A pop during the stretch reads as we're consolidating before the next leg up. They buy near the top and get stuck when price actually turns. Here's the final act of our example. After that sideways grind, price suddenly breaks above the old high. On the surface, a real breakout, then snaps right back down almost immediately. It's a trap. Every short seller's stop above that level fires at once. Breakout buyers pile in on FOMO, then the market reverses and everyone's caught wrong. Stop orders quietly pile up just above a well-defined high the longer it sits there. And when price touches it, all of it fires at once into a wave of buying that isn't real demand. Just orders executing automatically. It looks powerful. It's hollow. Once those orders clear, buying pressure disappears almost instantly. And the people who just got trapped start selling in panic, fueling the very drop that follows. Low volume on that break means real demand is basically gone. Heavy volume means wait for more confirmation. Either way, the trap isn't the top. It's the final test. The confirmation you need is price breaking below the most recent low with a fast, decisive move, not a hesitant grind. That's usually when structure changes, because with the last breakout, buyers cleared out, there's almost nobody left standing in the way of sellers. Price can fall quickly, often leaving a gap that becomes an important zone for the next step. So where do you act? Never chase price once it's already falling. After a sharp move down, price usually pulls back with a fairly clear bounce first, often enough that waiting beats reacting immediately. Two zones matter. The distribution zone right before the breakdown and the imbalance zone, the gap left when the breakdown happened too fast, which price tends to fill before continuing lower. Three things need to line up. The trap has happened and structure has changed, price has returned to one of those zones, and the candle shows sellers stepping back in with real conviction. An engulfing candle or a long, upper wick, stop above the zone. If price runs straight through without reacting, the thesis is wrong and you move on. This is exactly the kind of confirmation I lean on Invyra's Smart Money Index for, checking whether institutional flow is actually pulling back during absorption, rather than eyeballing raw volume alone. That's the difference between a real distribution top and a normal pullback. Volume ties the sequence together. Heavy on absorption, lighter on the retest, shrinking through the sideways grind, then confirming or denying the trap, and finally, heavy on every leg down once structure turns. It's effort versus result. Big effort. Little movement means the other side is absorbing it. Small effort, big move means the path of least resistance has been found. In crypto specifically, don't trust absolute volume. Wash trading distorts it. Watch the trend instead. Two situations break this thesis. First, price breaks the high and just keeps going without snapping back. That's a real breakout, not a trap, and it's dangerous, since triggered stops fuel even more buying behind them. You need both a snapback and a real structure change together. Second, price returns to your zone and runs straight through without reacting. The level failed, and the right move is exiting early, not holding and hoping. Let's be honest about the numbers. Setups built on this logic tend to work out somewhere around 59 to 65% of the time. Out of 10, roughly 4 will lose. The edge isn't the win rate, it's discipline and position sizing. 1 or 2 emotional oversized losses in a row is enough to knock you out of the game. So, a real top is pieces stacking on top of each other. Like the example we just walked through. Buying dries up, the retest confirms it with less force. The trap clears out the last buyers, and structure changes with a sharp move down. From there, you wait for price to return to one of those zones, watch for rejection, then decide. Evidence, not guessing. The same discipline applies to how I check data before it goes into a video. And once price actually breaks structure, I'll usually pull up Prism signal on Invyra as one more layer of confirmation. The same way I've shown on this channel before. It doesn't replace reading the chart yourself. It's one more layer that supports the read or tells you to slow down. Try walking through this on a chart you know well, and tell me in the comments if any part felt confusing. One last thing, everything here comes from personal experience and study, so push back in the comments if you disagree. This isn't investment advice or an invitation to trade any of these markets. Gold, oil, Bitcoin, and index, these are volatile, and you can lose everything without experience behind you. So think it through carefully before you act. Thanks for watching, and I'll see you in the next one.